The Federal Reserve minutes were released on Wednesday, and there wasn't anything entirely surprising about the minutes. The committee is clearly still divided on whether more interest rate hikes are needed and to what extent that is the case. They are still in an in-between point. At this stage, we're still seeing progress on inflation and the labour market, but potentially to a lesser extent than many will have wanted. We have seen tightening credit conditions as a result of the mini bank crisis back in March and April time, but it's not yet clear just how severe that tightening is. And there is now more concerns about the economy going forward and whether the lag effect of previous monetary policy measures is going to have a very detrimental impact on that, negating the need to tighten further. And the split seems to be relatively even in both cases. The Fed mentioned several policymakers favoured one or the other. And that suggests to me that the next meeting is very much a coin toss. The data in the interim is going to determine whether we get another interest rate hike at the next meeting or the one after. And I don't think a pause at the next meeting means we won't get one at the meeting after that. Or whether we're actually now at the peak of interest rates and whether we can start to consider the possibility later on in the year that we could start to see interest rate cuts, depending on just how severe the situation in the US becomes with the economy and whether the previous tightening efforts has a more impactful consequences for the labour market. We're seeing signs of that already, but we're still very much in the early stages of that. In terms of what this has done to interest rate expectations in the US, I think you can clearly see here that there is a divide here also. At this point in time, the markets think there's probably a 50-50 chance of another rate hike over the course of the next two meetings. That very much aligns with, firstly, what the Fed minutes seem to allude to, but also what we were just discussing right now. At this point in time, in the June meeting, there is a slight bias towards no rate hike. But again, over the next 2 months, that's going to be the crucial stage. We're now at the 1-year anniversary of the invasion of Ukraine, when energy prices spiked around the world and food prices followed. And we will now start to see more favourable base effects and therefore see what the stickier side of inflation is doing. It's still going to take some time to filter through the system. The second round effects in particular is going to stay with the core inflation longer than we're going to see in the headline, for example. But we will start to see signs of the impact of previous measures alongside more favourable base effects and get a better idea on where we stand over the course of this summer, at which point we'll see more clear and consistent messaging from the central banks. And that takes us to the UK. The Bank of England has been very vocal recently from various appearances before the Select Committee on Quantitative Tightening and then the Monetary Policy Report. And then this week we've had some very interesting economic data. That came yesterday in the form of the CPI data. Remember, the UK inflation was above 10% going into this, but this was going to be the first month, April, in the aftermath of the war in Ukraine, when we were going to start to see more favourable base effects. But headline inflation did not fall as far as people were expecting. And what's more, this was the big surprise. Core inflation did not stay stable. It actually rose by another 0.6 percentage points. So this is a massive concern for the central bank and also defies expectations and suggests that inflation is higher and stickier than the Bank of England, but also the wider markets believed. And we can see that this has had a clear impact on interest rate expectations here in the UK. If we take a look at those interest rate expectations, you can see that now markets are pricing in a number of more rate hikes over the course of the rest of this year. Interest rates are now expected to peak just shy of 5.5%, suggesting 4 more 25 basis point rate hikes over the course of the remainder of this year. This is a significant change from where we were previously of maybe 1 or 2. The fear in the UK has always been that inflation is proving stickier. The economy has been more resilient, the labour market has been more resilient, and inflation has been stickier. And the first inflation report with more favourable base effects very much supports that. Now, that will change over the coming months. We will see better inflation data. The energy price cap released today fell by around 20%. So that's going to have a big impact in terms of headline inflation on the energy market level. And base effects will also have more favourable base effect, even that aside, over the course of the coming months. But this is not the great start that the Bank of England was hoping for, especially on the core side. So at least in the short term, I think the narrative is going to be a lot more around sticky inflation and therefore the need for additional rate hikes and higher for longer. So let's take a look at what all of this means for the pound dollar chart. And again, as you can see here, we have been trading around those highs over the course of really the last 2 months since early April. We've been in a bit of a range-bound trading environment. Now, that range is very wide because of the volatility that we were seeing in this currency pair in the lead up to that. But what's interesting here is despite the fact that we've seen interest rate expectations in the UK rise considerably, we've seen the IMF revise up its GDP forecast for the UK considerably by 0.7 percentage points and no longer expecting a recession or negative growth this year. We haven't seen a stronger pound against the US dollar. We have seen a stronger pound against some other currencies, but not against the US dollar because the US dollar has been performing well recently. There's different reasons why that may be. Some suggesting we're seeing a bit more risk aversion. Some suggesting the fact that we're seeing improvements in the debt ceiling talks is leading more towards the US dollar. I think this is probably just more of a corrective move, to be honest, more of a technical move. I think we are in an uncertain period in the summer now with the economic data, as I've alluded to on a number of occasions, and I think that's led itself to into a more corrective environment, and I think that's what we're seeing in the US dollar. But what it means is the pound has continued to slip against the greenback. But now we've slipped back to a really interesting zone because we're now trading around the lows of that April and May period. We're also trading around the 55-day simple moving average, 89-day simple moving average band. That's the two purple moving average lines that you can see there. The lower part of that, I think, is the most notable support here, especially as it aligns with the 50% Fibonacci retracement. That's the long-term 50% Fibonacci retracement when we're looking back over a much longer period of time, going back to the summer of 2021 as the highs and the September of 2022 as the lows. If we look at a more recent Fibonacci retracement level, where you take the lows from March up to the highs of May, then you can see that this is the corrective pattern that we are now trading in. So in terms of areas of potential support, if we are going to see a continuation of that uptrend over the medium to longer term, then that is where some more interesting levels are found. 122.40 is the 50% Fibonacci retracement of that most recent fib level, and the 61% is 123.40. So again, another potential interesting area of support here if what we are seeing is a relatively shallow corrective move of that March to May trend. But again, the economic data over the course of the next couple of months from the US, the UK and beyond is going to have a considerable impact on inflation expectations, on interest rate expectations for the rest of this year going into 2024, and economic expectations as well. So all of those things are going to have a key role to play in determining how these currencies are going to trade going into the end of the year. And at this point in time, that is still a relative unknown.